We are now where we have a Mike Wilson stock market, and what I note is you mentioned it is picked over. I can't find scale. There's not enough to choose from. Where do I hide?
Yeah, well, thanks, Tom. Appreciate your kind words. I mean, look, I think the market is picked over because this is where we are in the evolution of this bear market. Essentially, when bear markets begin, they always go after the high flyers, things that are kind of ridiculously priced or where the earnings risk is more evident. And that's what happened really, kind of earlier this year, late last year, quite frankly, really began almost a year ago. And but as you kind of go through, people get high. It's like, when the water rises, you go to the higher part of the mountain. And so everybody's kind of crammed into the same stuff, just kind of waiting for, some conclusion to this story. Either we avoid a recession and move forward, have a soft landing, or we don't, and we clear the decks, and then we can move forward from there. We're kind of more in that second camp because our view on earnings is just so negative. Whether we have a recession or not, all of our top-down models, which are, pretty good, are telling us that, the spread between our forecast and the actual forecast by the street, bottoms up, has never been wider. It's the only time it's been this wide is, in 08 and then back in 01, and we know what happened there. So the earnings story is what we're focused on. The Fed is important still. Obviously, they're not getting off the gas here on their hawkishness, and nor should they. But that's pretty priced. I wouldn't be surprised if today we get some relief, quite frankly, led by the bond market after the Fed does their thing. Maybe stocks can rally one more time, but the end game for us is all about the earnings and the growth now. And we're just not optimistic there for the next 6 or 12 months, and that'll get priced pretty quickly.
So you've got 3,400 as the base case, 50% probability. Mike, 3,000 the bear case recession scenario, 40% probability. I put out this research, that quote on Twitter in the last week, and a lot of people wanted to know, where's the other 10%, Mike? What's the 10%?
Yeah, that's the mystery. Now, it's pretty straightforward. The bull case is just not that probable. I think, November, and we talked about this, as you recall, John, the bull case was Goldilocks. And we said, well, the probability of Goldilocks looks pretty unlikely. So our bull case, we can flex that from, 0, or not really 0, but 5 to 20%. We're, sort of 5 to 10% now. But the bull case is no longer Goldilocks. It's kind of this soft landing for the economy. However, that's not a soft landing for earnings. So, our bull case is not much different from our base case. We think maybe you don't make new lows in the bull case, but there's not a lot of upside, over the next 6 months. That's really how we manage money. We look at risk reward, and at 3,900, the risk reward is probably 5 to 1, on the downside. Is sort of the middle of our viewpoint, and that's at the S&P level. I want to make this clear because Tom asked the right question, which is this is the part of the bear market where you should be looking for individual stocks that you want to own coming out of this. Some are priced appropriately where you want to take that risk, but look what happened this week with FedEx. Clearly that wasn't priced. So you got to be really careful, thinking, oh, well, everybody knows this, it's already priced, and you get hit over the head and the stock's down 20%. So that's, everybody has their own risk tolerance. They have their own work. And, we have our own focus list as well. We're staying defensively oriented. We're not reaching for cyclicality or, kind of crazy growth stocks yet. We think it's premature for that, but we're getting closer. We think we're within a couple of months probably.
So there's an issue with how long this is going to last. And we were speaking yesterday with Chris Ferrone, who talked of a lost decade of profits on the headline level for the S&P, just based on the fact that yields are going to remain higher, inflation's going to be greater. Do you agree, or do you think that we're going to get a rebound on the other side of this 6 months, 12 months down the line?
Yeah, I think we will get a rebound, but our view for a while now has been we've moved out of the monetary policy dominant world to a fiscal dominant policy world. And what that means is that the Fed is no longer, and other central banks, quite frankly, can no longer smooth over the edges the way they have historically, because inflation, while maybe it's going to come down over the next 6 months, which is our core view, it's not going away. It's going to be dormant, and then we'll reaccelerate again in the next upturn. What's going to happen, Lisa, I think, is that you're going to clear the decks enough on expectations on growth that you can then have a reacceleration. And that will be driven by the natural ebbing and flowing of supply and demand, but also more aggressive fiscal policy. I think it's interesting to note in the last month, fiscal policy has been turned down like a spigot again, right? We have this debt forgiveness program here. We have this 200 billion pound stimulus for energy subsidies in the UK, which is equivalent to $1 trillion in a U.S. economic standpoint. So it's kind of interesting. You have kind of, everybody's worried about inflation, but the fiscal policy is working counterproductively to the monetary tightening. But that's the world I think we're living in now. And you have to understand that because it's not all bearish, right? There will be a time when fiscal picks it up again next year, even though monetary can't do its job. It has been doing in the past. And the Fed's job, in my view, and the ECB's view, and ECB's job, in my view, their main job going forward is to be funding the government. Whatever the government decides to spend, they will have to fund implicitly, very similar to the 40s analog that we've been using.
Mike, just one further question, and I think it's lost in the conversations I often see with you, that it's not just about an index level call with you and the team. There is some single name stuff in the mix too. Could you help us with just a call right now, something you do like in this equity market, something that has worked that you're sticking with?
Yeah, I mean, I think like the managed care stocks have been terrific, and that's an area that these are growth stocks, and they're not priced as growth stocks, and they never have been because of concerns about perhaps regulatory oversight and things like that. But healthcare in general, I would argue, is an area of the market where you have pent up demand from the pandemic, as opposed to payback in demand, like for technology spending or consumer goods, and for whatever reason, it still trades really cheaply. And that, once again, it goes back to this idea that there may be fear about pricing controls and things like that. But to me, that's a fat pitch, and that's an area we've had a lot of exposure, be it in pharma, managed care, some of the cheaper areas of healthcare, and I think that continues to work. The other area would be, say, integrated energy companies, where they're more defensively oriented, not so dependent on the price deck. They pay a great dividend, and you get some commodity exposure, as a hedge against inflation staying sticky or hot. But the overriding message, John, as you know, this year from us has been defensive, earnings stability, operational efficiency, boring type metrics. But it's been working nicely, and I think it will continue until we get the trough in this bear market.